Welcome back. There's a look at the Canadian dollar as we are now inside of 60 seconds on the Bank of Canada rate decision. The bank, of course, is expected to cut its benchmark interest rate by 50 basis points. That would take the overnight rate down to 3.25% from the current 3.75%. As one guest has already told us this morning, however, the Bank of Canada does have a track record of delivering decisions that are out of step with the consensus. Carl Shimada told us that. Carl also said that in his view, there was room for further pressure, downward pressure on the Canadian dollar as markets, currency markets price in an aggressive move down by the Bank of Canada, not only today, but, and here we have the decision, the Bank of Canada has cut its key interest rate by 50 basis points to 3.25%. So the jumbo-sized rate cut that the bank had been expecting, I should say the market has been expecting, has been delivered. There you see some interesting reaction on the Canadian dollar. It's actually moving higher on this news. I'm going to do my best to get you headlines from the Bank of Canada statement. The bank will assess the need for further reductions at coming decisions. That's a quote from the statement. Bloomberg News noting that the Bank of Canada is dropping the promise of further cuts if forecasts materialize. And that may be the reason for the jump up in the Canadian dollar that we're seeing in real time on our screen right now. We have two experts standing by, and I think I'm going to introduce them right now to get the conversation started. For instant reaction to the news that we've just heard, we're joined by Bipan Rai. He's Managing Director of Portfolio Strategy at BMO Global Asset Management. Charles St-Arnaud is joining us remotely. He's Chief Economist with Alberta Central and a former economist at the Bank of Canada. And Warren Lovely is Chief Rate Strategist at National Bank of Canada. And Charles, we'll start with you. Thanks for joining us remotely. What are your thoughts on what we've heard so far? No surprise in the decision. What about the statement from the bank that, according to Bloomberg News, that a certain portion of text has been removed? That's the promise of further cuts if forecasts do materialize. What do you think, Charles?
Yeah, well, I think it kind of makes sense. We're now at 325, which is the upper end of their band of the estimates of the neutral rate. So now they're more looking at, okay, does the outlook move? How much more do we need to do? So they probably feel that they probably don't have to cut as quickly. But I think from now, where the attention should be shifting is actually how low are we going to get? What is actually the terminal rate going in 2025? We know there's a lot of changes in the economy, from slower population growth to all the uncertainty from trade, from the possible trade war with the U.S. So it's clear that we'll have further rate cuts. But I think the question now is how far and how low we're going to go.
Warren Lovely, same question to you. What do you think of the bank's statement?
Yeah, well, you alluded to the Bank of Canada's surprises in the past. So I think in this regard, we avoided the surprise on the interest rate decision. I think, this forward guidance, for lack of a better word, is interesting. We're notionally, as Charles just mentioned, in this sort of neutral zone now. And I think it was appropriate to get there and to get there quickly, because we certainly don't need restrictive interest rates anymore. The big question is going to be, given the uncertainties that have already just been touched on and outlined, how much stimulus or how much further do we need to go? I think in our view, look, we still have an economy in transition towards weaker labor markets, and you're probably not stuck here at 3.25. So I would be expecting additional interest rate cuts from here.
Bipan Rai of BMO Asset Management, your thoughts, and how about tackling this currency reaction that we're watching right now?
Yeah, I'm going to very much echo what Charles and Warren said. I think we understand that the bank is now at what it thinks it's the upper bound of its neutral policy rate range, and maybe that was a justification for the removal of the language. But still, I mean, again, there are known unknowns. What's going to happen as soon as Trump takes office, and potentially with the tariffs? Does the Bank of Canada need to ease further in reaction to that? I mean, that's something that they're going to have to figure out as they go along. With respect to the movement in the currency, doesn't surprise me. I mean, this is a more hawkish than expected statement, and there was a sizable short position on the Canadian dollar. So I think we're seeing some degree of take profit there.
Do you think it is that removal of the language about further cuts that is causing the loonie to rise?
I think so. I mean, when you get to these sort of positioning levels, and I'm using futures positioning as sort of a proxy for the FX market here, but when you get to these sorts of extremes, I mean, things like changes in language, subtle changes in tone tend to matter a lot more.
Warren, an earlier guest this morning said that the Bank of Canada, among developed economy central banks, is on course for the most aggressive easing in the developed world. Do you still see it that way?
Yeah, and I think that's an appropriate way to be thinking about it. We have, as I think a lot of viewers know, in Canada, a very interest rate sensitive economy. So when you push interest rate policy into very restrictive territory, you should be expecting to see a significant come down in economic performance. And all you got to do is look at the labor market in particular. There are 4 signs of an economy that is reeling, certainly weak. So it is appropriate to be getting off of restrictive policy very quickly. That's why they went 50 in October. That's why 50 was the right move today. And it's why I think we probably still have further to go.
Warren, how decisive, I'm sorry, not Warren, Charles, remotely from Alberta, how decisive were the weak employment figures on Friday to the bank's decision today, do you think?
I think it factors in it. I think the fact that we're continuing to see some labor market slack continue to grow, kind of push them a bit more, or give them a bit more the confirmation that they wanted to go a bit more aggressively. But I think when we look overall, it was clear that the Canadian economy didn't need a restrictive monetary policy. And it's also clear with the direction of where the economy is going next year that they needed to cut rates relatively rapidly to bring to some kind of neutral. And I think the other question is that we have to ask is when we're talking about we would need to have some more, we'll see more cuts. I think we might see a Canadian central bank that will be much more aggressive than what the market is expecting. We probably have a slightly lower, or the neutral rate is probably closer to the lower bound of the Bank of Canada estimates, just because of the demography that we're demographic slowdown that we'll get in 2025. So we might see Bank of Canada ending the year at 2, maybe shouldn't be out of question.
Bipan, the bank in its brief one-page press release is making reference to a couple of recent policy decisions in Ottawa. One, reductions in targeted immigration levels suggest the GDP growth next year will be below the Bank of Canada's earlier forecast. There will be effects on inflation, but likely more muted, the bank says. Two, and more recently, the Bank of Canada pointing to the temporary suspension of the goods and services tax on some consumer products, one-time payments to individuals. Those $250 checks will affect the dynamics of demand and inflation. How big do you think those factors are from the bank's thinking?
So for the first one, I think it is very, very important because if we look at the October projections and we look at the real data from Q3, we came in at 1%, I believe. The bank had 1.5 penciled in, right? And if we look at the very early data for Q4, we're tracking just a little bit below 1%. And Q4, the bank has penciled in at 2%. So you do have a sizable amount of slack that's developing in the Canadian economy. Next year, that potentially could become even more problematic, which tells us that the risks to inflation are towards the downside. Now, with respect to the goods and services tax holiday, which is temporary, I should also add, it really depends on how big that multiplier is, right? So if we do get somewhere between, say, 2 to 3 times, I mean, that could have a sizable offset to maybe the weaker data that we've seen come in so far for Q4 and even into Q1 as well. But then again, it doesn't really sort of dissuade us from our view that the bank does need to cut further and potentially move below the lower end of its neutral policy rate range, closer to the 2% level that Charles mentioned, I think is fair.
Warren, I do not see a reference to relations with the United States in the statement. I would assume that Tiff Macklem and Carolyn Rogers will be asked about the possibility of a tariff war. How do you think that figures into the bank's thinking?
Well, look, the way I think of it is we're trying to operate this economy, whether it's as a monetary policy maker or a fiscal policy maker, really without functioning gauges. Or let me put it another way, without really models that are well calibrated to today's economic uncertainty and demographic reality. So to some extent, it's great for the Bank of Canada to be giving us guidance in terms of where they, trying to intimate on forward guidance. We don't really know where we're headed. We don't really know what the president-elect will be doing when he's sworn in on the 20th of January. We still don't know for certain what other fiscal agents, governments will be doing with their own fiscal policies. So a tremendous amount of uncertainties, not least of which, of course, is the trade relationship with the United States, which is vitally critical, probably argues for just a degree of caution here in terms of where we ultimately need to go on interest rates.
Charles St-Arnaud in Alberta, how close are we getting to the neutral rate? And just explain to our viewers what the neutral rate is.
Yeah, I think at the moment, the neutral rate is basically the point where monetary policy is neither restrictive, neither loose. The question is that it's hard to know where it is because it's not observable, so it has to be estimated. But there's also a lot of factor next year that might actually push the neutral rate in lower than what the Bank of Canada has, because the Bank of Canada is basically, and Tiff has referred to that, is that it's the rate at which the economy will settle when there's no more shocks. And we're never there. There's always shocks. So, and my thinking is that when we look at what's good, all the evolution of the various economic indicators for next year, potential growth next year will be extremely weak. If the federal government goes as aggressive as they think on immigration, well, the labor input side of potential growth might be very close to zero. That means that potential will only come from labor productivity, which is not the greatest record when we look at the past few years here in Canada. So potential might be very low, maybe even below 1%, and that will drag the neutral rate lower. So that's why there's a lot of uncertainty in terms of where are we going to end in terms of this easing cycle. Is it 2? Is it 2.25? Is it below 2? So something that we'll have to look into going into next year, because that will really determine how much the bank can cut to stimulate the economy.